Today we have with us Eric Boyce, who is an experienced financial and investment professional, and he's going to be sharing with us how companies can prepare for an acquisition, primarily from an executive retention perspective. Thank you so much, Eric, for joining us today.
Mark, it's a real pleasure to be here with you.
So let's kick us off and share with us your background. We'll start from there.
Sure. Well, I come from an investment background primarily. I've run research departments. I've done due diligence projects on public and private companies. I've been a portfolio manager and all of those things. My career spanned roughly 27, 28 years in doing all of that. So I've done everything from put on the hard hats and walk the plant floors to understand how certain companies operate and how certain companies are structured. And I put on bunny suits and been in clean rooms to learn how semiconductors are made, and so I've transitioned that now into the running the investment company that we have now.
And what are some of the things that your investment company offers to business owners?
Most of the wealth of an entrepreneur is tied up in the enterprise. Maybe they've got some assets that other people might care dearly about, but how can we help them as wealth managers and practitioners help to grow that enterprise value such that when they do exit, it's a more satisfactory exit and it provides for a better next series of steps for that entrepreneur. And we feel that that's a significant void that we're trying to fill in doing what we're doing.
That's a great segue. So what are some of the ways that you're able to add value in terms of optimizing a company's value?
Well, I think first and foremost, a business owner tends to have an emotional feeling as far as what their value is concerned, and it's kind of an age-old problem. And they might have a friend who sold a company for X multiple of EBITDA or revenue or whatever the case may be, or they may inherently feel that they've had some track of growth and that my company is worth X. Well, how did you arrive at that value? And oftentimes they get disappointed. And the Exit Planning Institute says that 72% of owners are not satisfied with their exit price.
Wow.
Or exit experience, I'll call it, which obviously includes in a large measure what they get for their company. And why is that? And I think a lot of that has to do with the unknown. And so there are a lot of people out there that claim to be exit planners, if you will. But what does exit planning really mean? And so we wanted to dive deeper into that and what is useful for an owner, to understand or to have knowledge of to help them begin that planning process. And so that's what we set out to do. Now, I'm not sure if that completely answered your question, but but obviously having a valuation is very important. So you've got a baseline with somebody who's an independent appraiser that can use the industry standard tools to come to that value, and then from there do an assessment with professionals that are subject matter experts in their field to give them an idea of what they're doing right, but also give them a sense of what the anchors to that value might be. And oftentimes what we've found is that the owner has no idea that those things existed or that those things had such a significant impact on their valuation. And so that after that period of discovery, then those owners can then address those shortcomings, especially if they have 1, 3, and probably 5 years to that exit point, whether it's a family transition or sell to a third party or what have you. If they have time, then they can work on those things that have been identified in that process. And most business owners, the whole notion of exit planning is really foggy. When people approach them and say, well, are you going to do exit planning? They'll say, well, I don't have any idea who I'm going to call. I don't know how much it's going to cost or how long it's going to take. And usually when they get to questions 2 and 3, they just call a timeout and say, I'm running my business. I've got to make my quarter. I've got, a widget to manufacture, and I just don't have the time. So in our view, that's a huge opportunity cost. And so I think there are tools that business owners can avail themselves to that can help them gain the understanding that bridges that valuation gap that in most cases they don't even know exists.
So let's dive a little deeper into what exactly exit planning means, when a business owner should do it, and some of the key pillars, as you kind of described,
Sure.
they should be looking at.
Well, I think ideally you want to catch somebody who's not on the eve of a transaction, obviously. So, but somebody, and I would say this, really for any industry, particularly service industries where there's key employee risks and, talents and attributes and characteristics that that are likely to not be sustained in the transition in the current form that has made that entity, successful. But anytime you can get a business owner that has, at least, 5 to 10 years, and that's not too early to do exit planning. I know in a lot of the entrepreneur, the small company tech development world, I mean, exits are measured in terms of, months and quarters as opposed to years. But I'm talking about kind of mainstream American, manufacturing and service businesses. I would say, first and foremost, that age is not really best word I'm looking for is it shouldn't be an impediment. It's one that an entrepreneur that's maybe 35 shouldn't say, well, I'm too young to think about this, because there may be things that that in the enterprise, like a key person risk, that that they're so deeply tied they can't see more than about a foot in front of their face, and there's something out here on the periphery that could be a huge value torpedo, I'll call it. So I think even at that level, saying listen, I need to lock down this person because of what they bring to this company, because that's going to have value that's going to grow exponentially over a period of time. And if I want to go to the ranch or the lake in 10 years, I need to make sure that that's locked down today, because I don't want to get 2 years down the road growing sales and all of a sudden have a hockey stick, downward. And so it's like planning for contingencies almost as it is planning for a transition, if you will.
So what I'm hearing,
that makes sense.
It does. What I'm hearing you say is that a large part of a company's value is the value of their employees, is the value of its people.
Oh, no question. No question.
And so when a company is looking to get acquired, they want to make sure that they have processes in place that retains those people. Is that correct?
Absolutely.
Okay.
Well, and I think, and that speaks to culture, it speaks to efficiency, and it obviously speaks to cost as well. And so, in a potential acquirer of, again, I'll use kind of I'll poke at the service, revenue model. Because generally it's because of key relationships. It's because of some key intellectual capital that's inside the firm. It's because of some certain way that somebody has done things and created a process that is not easily replicated if they were to suddenly disappear or get hit by the truck or whatever. And a potential acquirer, certainly in doing a valuation, and we're valuation experts, so we certainly analyze those types of things. But if you've got a key person risk, that's obviously a haircut to value. Or if you haven't developed your talent, that's obviously a haircut to value. And that could be training and development. It could be having the right organizational structure that allows your best and most talented people to kind of rise up, but then therein you have a retention issue too, because you don't, if you're promoting from within, you certainly don't want to lose that talent. But a good valuation appraiser is going to take a look at the personnel issues and really dive deep into that, and I think that's a very common misperception by business owners that get a valuation and say, well, I had $4 million in revenues last year, $5 million this year. Here's my EBITDA, and it's gone up 20%. That's what the company's worth. Well, yeah, that's really, really important. But these other kind of soft components and these qualitative components are I'd say almost equally as important. And it's especially critical on the eve or in the planning stages of an exit, because that's certainly what a buyer is going to be paying attention to.
And how would you value some of those soft components?
That's a very good question, and that's where valuation becomes almost as much an art as it is a science. But I think you can look at, I'll poke at sales right now. So if you have a key salesperson that has a key relationship, well, how much is that relationship worth? And how much is that relationship worth over 5 years, discounted at some percentage, some discount rate? Okay, well, we can put a value on that. And we can, as we're providing a value for the enterprise, well, we can, put a haircut to value, and that's, there are industry kind of standards, for things like minority discounts and control premiums, but there's also kind of some industry, I call them axioms for key salespeople and things like that. What kind of a haircut needs to be applied, and and it could be 20, it could be 40%, and if you have a key customer or key client risk, how much is that worth? And what's the moat around that client? How sticky is that client? That's why valuations can cost a lot of money, because if you're doing the appraisal right, you're digging down and peeling off the layers of the onion to say, okay, well, fine, you've got a customer that's 50% of your revenue. Why is that? Are you sole source to that? Are you a sole source supplier or of some type of service to that? Can they make what they do or do what they do without you? Or are you, more of a commodity, and and the whole price elasticity question is different. You have to figure out what that value proposition is, and kind of weigh that in. If that's a much more nuanced answer, I think, for the question that you asked me. But suffice it to say, it depends.
Yeah. I'm curious, like if a business is really reliant on maybe a single team member or a single supplier or a single customer, how does that impact the valuation? I mean, do you increase a discount rate? How does that, is there like a calculation that, like a rough, just general calculation you kind of run us through, like how that actually works?
Yeah. Well, I mean, it's a great question, but I'm sorry to say I'm going to give you a nuanced answer, because it really does. It does depend. And I think, going back to my previous answer, if you can put your arms around what the revenue loss would be, and what the cost structure is, then you could kind of get your arms around what's the value impact. And what I'd say not what but what a good appraiser should do is just say, let's just not look at 2019, but let's look at the continuum, and maybe even look into the future, and what is that worth? Because if the valuation of a company is based on the expectation that they're going to grow at 10% for 3 years, well, and if you lose that, well, that's obviously not going to happen that way. And so, it's an involved kind of calculation, but it does involve judgments, and that's kind of the nature of business valuation. That no two companies are out of a cookie cutter mold. There's nuances in each that. So I know it's an excellent question, and I'm glad you asked it. But it's just it really does kind of depend on some of the key circumstances. But a good appraiser, I'm sorry I'm being long-winded, but a good appraiser can put some mathematics around it to say what's the value at risk.
Do you have any stories that you could share of a company that maybe didn't really know what their value was?
There was a company in the furniture distribution business that had a rapid growth rate, 2 owners, older, and they had 2 very differing ideas on how to grow the company. But at some point there's going to be a liquidity event just because of age, and I think one felt like more comfortable maintaining a status quo type environment. The other one wanted to grow, but there were spatial limitations. So there was a physical plant problem where they couldn't grow that much. So the one owner was confounded by the limitations, but the proposition of them taking that next step was was exiting that space, which they own and it had value. It has value. But then they'd have to sell that and buy something that's more expensive, which would have a negative impact on the P&L for some point in time, even though it might be owned in a different different company entity. But that was kind of a conundrum of it's easy to extrapolate business trends, but you had a very a hard barrier to growth.
Yeah.
That's one. And something that I'll kind of bring back to kind of real world kind of problems is that we did a valuation for a company that had 3 owners, and so part of our discovery process was ascertaining do you have a buy sell? What if one of you hits the bus tomorrow? What is the transition plan? And because that's obviously very important in knowing what the continuity is going to be for the business. And 2 piped up and had done some estate planning. And estate planning, just by way of background, is not designed just for people with more than $10 million in net worth. I mean, it's everybody should be doing it. And in this case, 2 of them had done it. One of them had part of their underfunded buy-sell plan that was pointing where the beneficiary had not been updated, and so it was pointing actually to an ex-wife that he didn't know where, and he didn't know where she was. And the 2 other owners sat in this discovery process and said, "We had no idea." So in that case, I'd say if you don't do the preparation, you are literally as strong as your weakest link. And that's a great example of a weak link where in that discovery, obviously we had to take that into consideration. They fixed it, but it was a consideration, because if that person left, then that's a massive I've been on the outside looking in as a consultant on several instances where there's been a business divorce where 2 parties and one's not engaged in the business but who is an owner, and then control problems, and especially within families. It's just it's costly in terms of you've got to get legal people involved, and that's money. That's distractions away from the business, and that's money. So that's anyway a good example of just how you can be as strong as your weakest link.
Yeah. So what are some of the main reasons why company valuations maybe aren't as high as they could be? Because you analyze a lot of companies.
Yeah.
And so do you see kind of consistent themes around why valuations kind of take a hit?
Yes, and I'd say more often than not, it's a key person risk or key client risk, no, I'd say that those 2 are really at the top of the list.
So let's segue that into
Sure.
How do we ensure key people stay? What are some strategies?
Well, I think most people feel it's almost a fatalistic view that if you want to keep somebody, you either pay them more or you give them a piece of the company. And if you pay them more, that's money in their pocket currently, and it has certain tax implications. They're getting taxed more. And some people say, listen, I want equity. Some people just want money. I think as we transition from one generation down to the millennials and then eventually to Gen Z, I mean, each generation kind of feels a little bit differently about that. And I think the current generation of employees underneath an ownership umbrella are beginning to get the sense that, if I get 10% equity, what does that really do for me? I'm not in control. Do I really have a say? Am I really in the inner circle? And what does it do for me? And obviously, it doesn't have a fungible value unless there's a transaction down the road or there's some kind of liquidity event or what have you. So I think the calculus has kind of changed, and I think owners still, in some respects, feel like that's a viable mechanism. But the challenge is to get them to think differently, that there are other alternatives out there, like Section 162 executive bonus plans, SERPs, which are supplemental executive retirement plans, and these are non-qualified plans that can provide both incentive, deferral, and in a lot of cases some very favorable tax treatment on distributions down the road. We've had quote unquote deferred compensation around for quite a while, but that's an employee making voluntary deferrals of income into the future. The issue that an employee has to wrestle with is that those assets, notwithstanding the Section 162 plan, which is different, but those other non-qualified plans are basically still on the books of the company, and so they're subject to claims and forfeiture, in bankruptcy and litigation and things like that. But those things are not as well understood in total, and I think if they were, you'd see more companies using that as a vehicle as opposed to equity. And so, if an employee, you can put vesting schedules. The idea with non-qualified is that you can single out a specific group. I could say, Mark, you are essential to my business. I'm going to create a plan just for you. And that's complete anathema to the whole qualified plan world that lives under ERISA. The ERISA Act of 1974, which governs qualified plans like 401ks, where you have to offer it to everybody. This lives on the other side of that, and if you do it right, you can avoid that regulation and just say, listen, I can target you, you, and you, and oh, by the way, I can provide a plan for this 1099 consultant, and I can provide a different plan for my board of directors, and everyone gets incentivized, to help grow the business, and so it, if the business grows, then that economic benefit accrues to those types of people, but you're not disadvantaging your whole employee base, though.
Yeah.
So that it's a long-winded answer to your great question, but I think that's one good vehicle to help drive increased retention.
Could you dive a little deeper into what Section 162 plans are and what SERPs are and how they kind of differ from each other?
Sure. So I'll just say on Section 162, now you could use stocks and bonds, you could use annuities, you could use life insurance, and I'd say life insurance, you could use a life insurance product that is specifically geared towards cash accumulation, not the retail product that we would buy from our broker down the street, which is geared towards death benefit. But in both the stocks and some cases the annuity, you get you get mark to market, you get capital gains, you get an annual kind of hit in terms of transactions and income and capital gains and things like that. In the life insurance side of that, you don't. It's just it's a vehicle that accumulates over time, and then you take. If you do it right, obviously you can have tax advantage distributions down the road. But a 162 plan basically entails a company acquiring in behalf of a key employee. I'll just continue to use the life insurance example, but they'll acquire a life insurance policy for that person. The person owns it. Obviously, that's a taxable benefit that's being provided, so the employee has to pay tax on it, but generally you'll get a gross up from the company, so there's no net impact for the employee. And then they own that, and so they can use that for house, car, education, whatever down the road, and you could write kind of restrictive endorsements on the policy that say you can't take a distribution for 5 years or 10 years or whatever the case may be. That probably is more applicable to the executive ranks and board of directors. When you deal with key employees and maybe to a lesser extent consultants, you would do more like a SERP, which involves company-owned life insurance as opposed to life insurance that's purchased by the company for the key employee, but it's company-owned. And you can put a vesting schedule and a restrictive employment benefit agreement, or REBA, on top of that says if you leave after year 3, then there could be a clawback of some of the benefit we provide you, or if you need to stay to year 5, which may be a little long, but it basically it provides a break. It's not going to handcuff somebody to a desk and prevent them from walking out that front door, but it's going to provide a big disincentive that they're leaving behind something, or they know they're going to have to pay something back.
Yeah. Would you say that this applies more to employees who have families rather than kind of the younger generation?
I think that's a fair question. Obviously, you have a more complicated P&L and balance sheet when you have a family, and a more complicated set of expectations and future events. But I mean, I would argue though that it still has applicability to people that are younger and single, because the anticipation is 4 out of 5, probably more than that, are eventually going to get married and be in that position. So it's a matter. It's trying to find that happy intersection of preference and opportunity.
Yeah.
Because some people are going to say, like I said before, they say, well, I want a piece of the action. And some people are going to say, listen, I want the money now, right? But if a company can come in and make the argument, well, if we take the money that we would have paid you more now and put it into the SERP, if you will, or this deferred compensation vehicle, if you will, and let it grow for 10 years, well, here's your downstream benefit. I mean, that really opens eyes. And there really aren't too many people that are doing that right now. And I think getting back to the general theme of M&A and how it impacts the value of a company, if you could as a valuation appraiser, if I saw somebody with a non-qualified plan on the books to lock down 3 key employees, that would absolutely have a bearing on my valuation in a positive way. Anyway.
Why do you think more companies don't do this?
I'd say it probably has a lot to do with awareness and education. And, like I said, deferred compensation has been around a long time. But some of these other areas, SERPs, 162s, have been a byproduct of some legislative change and treatment changes by the IRS over time. So there just isn't as much information out there. But I will add, if you'll let me, is that all politics aside, what President Trump has done with this executive order in trying to enhance multiple employer plans as a better, more cost-effective vehicle for people that don't have 401ks to get into that space, I do think that action is going to help draw more awareness to this whole notion of alternative forms of compensation and retirement savings.
Gotcha.
Yeah. As we tried to tackle the whole issue of what do we need to assess that becomes important in what an owner, in providing output that an owner can use, kind of that news you can use that they can help bridge that value gap. Well, we talk to business owners, people that are in business that have sold businesses. We talk to business brokers, small and middle market M&A folks, and spent about a year on due diligence trying to find out, well, what's really important, what matters most in the successful transition sale, and what often gets, for lack of a better word, screwed up. And that it really falls in 5 key areas: finance, operations, sales, leadership and culture, and owner psychology. And so, in the financial area, obviously you have to have good statements, good controls. You have to have a good set of procedures. And obviously, bottom line is you have to have good books and a good process, and you can't have one person writing $30,000 checks. Just basic blocking and tackling, then mitigating your risk. operations. Often people don't spend enough time kind of looking at their margins and what's my unit cost for this widget or what's my unit cost for this unit of labor, if you will, and they lose track of they look at raw profitability instead of the opportunity costs that they're incurring by not doing things operationally very well. And some of it also relates to HR, human resources. I mean, we've seen more than once somebody not having a handbook, not having their handbooks and not doing, making their employees aware of certain Department of Labor requirements. It can be as simple as that. And on the sales side, I'd say we find a lot of companies that have kind of gone from the garage startup to, $5, $10, $20 million that still operate across all three of those pillars, actually. But I think especially in sales, that they're order takers or they've got somebody on staff that has a great relationship with X, Y, and Z, and we're just going to milk that. But they have no sales strategy and really no executive on staff to say, well, how do we maximize the use of CRM and how do we attack our end markets and what do we do in terms of engaging marketing to help us do sales, and those are two different things. So that's that. And then leadership and culture is kind of self-explanatory. But most people, it's such a fuzzy concept that I think if you don't have somebody that is a working professional that can look from the outside in, I think companies would find that on this supposed heat map, if you get 5 executives in a room, they may have characters and traits that make them operate really well as a team, but if you remove one out of that equation, then it just gums it up, and you're not nearly as efficient. So that's really important, and that often, when you don't have that leadership and culture tied down, that often can impact a business. Again, that's what a seller is going to look at, and then owner readiness really relates to the owner psychology. What's your motivation? Are you motivated to sell because you're tired and frustrated of the business? And if you were able to fix some things that could be assessed, would you be happier? And would you be willing to hold on to that business longer, or would you have a better transition? And some people they get a divorce, and then they've got to split up the interest. Some people, have that they've got to deal with, but other people have the choice of saying, why am I, selling, and am I ready to sell, and am I ready to not go to the office that's been my home away from home for however many years. So there's more psychological elements over here in owner readiness, but those are the 5 key pillars of value as we call them.
I'm curious, does the value of culture differ by industry?
Yes, I think so. I think if you're a widget manufacturer and your key differentiator is being able to provide volume, having that throughput is paramount. But if you're providing a service, and those are two, you could drive a truck through those, manufacturing and service, but, service is much more about people, and I think in industries that are especially more competitive on either side, the differentiator is, are you efficient? Because if culture is bad, oftentimes, the other things, finance and operations, are not going to be good. Because you kind of lack that esprit de corps, and a customer is going to tell that. And if they're price sensitive, or if depending on the price elasticity in that particular business, they could say, well, listen, I don't feel like you have your arms around your business, whereas they do, and I can pay $20 a widget less, or whatever. So I think it does. I think it does.
Do you have any last piece of advice for business owners looking to potentially sell their company?
Well, I think yes. And I would say, particularly on the valuation side, is to have somebody provide a baseline. Again, if you're not ready to sell, today, and it's going to be 1, 3, 5 years down the road. At least have a baseline. Then you can benchmark it and say, well, in year 2, we've updated that valuation and we've picked up, a 5% value. Well, does that 5% match your sales growth? And, I think those are really, really helpful things for a business owner that sits here today and says, well, I want to be at the ranch in 5 years. Well, it's a great tool for them to help them set a baseline so that they can meet those objectives. And I think a business owner, too, needs to plan out what that, call it the afterlife, looks like. I think a lot of people want to sell, and there are a lot of serial entrepreneurs out there that want to go on to the next thing, but there are a lot of people that that want to go retire and just kind of live off the fat of the land, so to speak. And I think getting your business right sized, knowing what your valuation is, and doing individual planning that gives you some perspective on what that picture looks like for you as an owner is really important.
That's great advice. Eric, where can people go to learn more about you and your practice?
Well, they can go to our website our firm is BKA Wealth Consulting Incorporated. We are in Cedar Park. We have our business consulting is operated out of our single member LLC called BKA Business Consulting, which is where we do valuation. You can go to the web and find us at www.bkawealth.com.
Awesome. Thanks again.
Mark, thank you so much. It's been a real pleasure.